Okay, so let's start. We want to introduce a topic, I want to introduce a topic called reconstruction. This is in the advanced financial reporting. This is a topic in the advanced financial reporting of the advanced level. That is what used to be called Section 6 advanced level. A paper used to be in Section 6. So let me introduce it now. Now, if a company has been making losses, let us assume that our company is company A. It has been making losses over a long period of time. When a company has been making losses over a long period of time, it becomes difficult for that company to pay dividends to its shareholders. 2, it also becomes difficult for that company to attract potential investors. It is obvious no investor would want to buy shares in a company which has been making losses. So once a company has been making losses over a long period of time, the effect we have said is that that company is not able to pay dividends to their shareholders. And number 2, it also becomes difficult for that company to attract potential investors. So the most logical thing to do, the most logical thing for you as a company to do is to reconstruct yourself, so that from now onwards you eliminate the accumulated losses, so that you eliminate the accumulated losses from the books of the accounts. You eliminate the accumulated losses from the books of the accounts. Remember, I've told you, there is no investor who would want to buy shares in a company where they keep seeing retained losses in the balance sheet every year, retained losses, and so on. No investor would want to buy such shares in that company. So you as a company, the most logical thing for you to do is to reconstruct yourself. Now listen. Therefore, the aim of reconstructing a company, is to help that company to eliminate the accumulated losses from the books of the accounts, and to enable that company from now onwards to start its activities in a more attractive and profitable manner, to allow that company from now onwards to start its activities in a more attractive and profitable manner, So that is the aim of reconstructing a company. That's the aim of reconstructing a company. Now, so the question is, how do you reconstruct a company? We have said the aim is to do what? To help that company to eliminate the accumulated losses. We don't want to reflect losses again in our books of accounts. No, from now on, we want to eliminate those losses, and again, we want to start our activities in a more attractive and profitable manner. So the question is, how do we reconstruct a company? There are 2 ways a company can be reconstructed. One way is through what we call internal reconstruction. And the second way of reconstructing a company is through what we call external reconstruction. So those are 2 ways in which a company can be reconstructed. Now, if as a company you choose to reconstruct yourself through an internal reconstruction, then listen, all the stakeholders of that company will be called into a meeting. All the stakeholders. These include stakeholders like ordinary shareholders, preference shareholders, maybe debenture holders, creditors, and all other stakeholders of the company. They will be called into a meeting so that they decide, how can we help this company? We are stakeholders. How can we help this company to eliminate its accumulated losses from the books of the accounts, and to enable this company to start its activities from now on in a more attractive and profitable manner? So the stakeholders will sit down and come up with a scheme on how to help this company to eliminate those accumulated losses. For example, the ordinary shareholders might tell us, we owe them 20 million, but they are willing to write off from their capital, they are willing to write off maybe 2 million shillings from their capital. In the process of helping this company to eliminate the losses, that's what the shareholders might tell us. We talked to preference shareholders. We asked them, what can you do for us? Maybe the preference shareholders said, we owe them 30 million. Maybe they tell us they are willing to write off maybe 5 million from their capital. Okay? We call the debenture holders. What are you willing to do? They tell us, yes, currently we owe them maybe 40 million. They might tell us they are willing to write off maybe 4 million from their loan or from their debenture. So you can see, therefore, same to creditors. You can see, therefore, that when it comes to internal reconstruction, effectively, we are reducing the capital of the company. We are reducing the capital of the company. We are reducing the capital of this company. Effectively, we are reducing the capital of the company. Listen carefully now. If therefore we are reducing the capital of the company, it means that internal reconstruction, the main aim of internal reconstruction is what we call capital reduction. So internal reconstruction, some books have called it capital reduction. That's another name for internal reconstruction. So which means, listen, the stakeholders will come up with a scheme of capital reduction. They design, or they have to develop a scheme of internal reconstruction, which we are also saying they have to develop a scheme of capital reduction, where the aim is to reduce the capital of the company. So that they help the company to eliminate the losses, they have to reduce the capital of the company. They have to reduce the capital of the company. Now, if as a company you are going through this reconstruction process, but you want to reconstruct yourself through external reconstruction, we were assuming you are a company A. We were assuming you are a company A. And you want to reconstruct yourself through external reconstruction. Now, when it comes to external reconstruction, then another company, let's call it company B, that company B will have to come and buy the business of company A. Company B will have to come and buy the business of company B, company A, sorry. In other words, this company B could be another existing company, or you may form a new company. You may form a new company called B so that it takes over the business of company A. So this B may be a newly formed company, So when it comes to external reconstruction, we normally say that another existing company or a newly formed company will have to take over the business of the company that is being reorganized. In other words, company A, listen, company A will sell their business to company B. which could be a newly formed company or another existing company. So effectively, those are the two approaches that a company can reconstruct themselves. So you can reconstruct yourself through internal reconstruction, which I've told you is the aim is to reduce the capital of the company. Internal reconstruction, the major aim is to reduce the capital of the company. So that's what internal reconstruction is all about. It is where capital of the company is reduced through a capital reduction scheme. We are saying internal reconstruction occurs where the capital of the company is reduced through a capital reduction scheme. Good. External reconstruction occurs where another existing company or a newly formed company takes over the business of the company being reorganized. Good. So today, I want to introduce that area of internal reconstruction. I want to introduce that area now of internal reconstruction. So let me introduce how internal reconstruction is done. So we want to discuss internal reconstruction. Internal reconstruction. I have told you the stakeholders are called into a meeting so that we as stakeholders, we agree what are we going to do to help this company to eliminate its accumulated losses. Now, for example, we called the ordinary shareholders. Don't forget, I've just told you a short while ago here that you as a company A, you owe the ordinary shareholders 20 million. You owe them 20 million. That 20 million, I want to assume, listen carefully, I want to assume that 20 million comprises of 2 million shares of shillings 10 each. Then as a group of stakeholders, they agreed, that is the ordinary shareholders, they agreed that they are willing to write off 1 shilling per share. They are willing to write off maybe 1 shilling per share, which will come to 1 shilling times their 2 million shares, that will come to 2 million. So I want to take you through the accounting entries for internal reconstruction. I want to take you through the accounting entries for internal reconstruction. Now, we have called the ordinary shareholders. We have asked them, what can you do for us? Our company has ordinary share capital, which is balance brought down 20 million. Let me put it that way, 20 million. They are willing to write off 1 shilling per share. So out of their 10 million shares, no, 2 million shares, they are willing to write off 1 shilling. 1 shilling times 2 million, that comes to 2 million. So our number one entry is in the internal reconstruction. The first entry is with amount written off on share capital. Let's call it just share capital. With amount written off on share capital, whatever the capital, it could be ordinary, it could be preference, but the point is, with amount written off on share capital, you are supposed to debit share capital, and we shall be crediting, that is with 2 million, we shall be crediting an account we shall be calling capital reduction. With you credit an account called capital reduction. So number one entry is with amount written off on share capital. Whatever the share capital, whether it's preference share capital, whether it's ordinary share capital, you debit share capital and you credit capital reduction. And you come and say your ordinary share capital, 2 million. That's our entry number one. That's our entry number one, which says with amount written off on share capital, you debit share capital and you credit capital reduction. Good. Now, there are other group of stakeholders, or another company might have decided, listen, still on ordinary. The stakeholders decided, why can't we cancel the old shares, that 20 million capital, why can't we cancel it and we replace them with new ones? So they could have decided that the approach of reconstructing the company is to write off the old shares and maybe replace them with another 2 million shares of shillings 9 each. If they took that approach, listen to this now. So the company decided, or the stakeholders decided, that they are going to cancel the old shares and replace them with new ones. If that is the case, how do you go about it? You will still go back to your share capital, that ordinary share capital account, which we have seen has a balance brought down of 20 million. These guys decided to cancel that share. So it is obvious you will debit ordinary share capital by 20 million and you will credit again this account called capital reduction. You will debit, let me put it somewhere here so that I get enough space. I want to squeeze it somewhere here. Let me squeeze it somewhere here. Capital reduction. So they have debited, listen, we have debited share capital and credited, we now credit capital reduction. You come and say your ordinary share capital, 20 million. Then they have agreed to replace the old shares by issuing another 2 million shares of 9 shillings each. So the nominal value of the new shares issued is how much? It's 18 million. Is 18 million, which is 2 million times 9. That's the nominal value of the new shares issued to replace the old ones. So with that nominal value, you will debit capital reduction by 18 million and you credit share capital. And you come and credit ordinary share capital again, and you come and say your capital reduction, another 18 million. Now, if you look at these two approaches, as far as capital is concerned, the first time I told you the ordinary shareholders were willing to write off 2 shillings, no, 1 shilling per share. And so we saw the company had 2 million shares of 10 each. The shareholders were willing to write off 1 shilling per share. So we took 2 million times 1, we got that the shareholders are willing to write off 2 million. I told you, you debit share capital. I told you, you credit this account called capital reduction. That's one way the question can be framed, where you are given the amount write-off per share. Other questions, instead of using the amount write-off per share, they tell you, cancel the old shares and replace them with new ones. For example, we have said, suppose our company had a capital of 20 million and they agreed to cancel the old shares. So you go to the share capital, you debit it, and you credit capital reduction by 20 million. Then with the nominal value of the new shares issued, which we are assuming is 2 million times 9, that comes to 18 million. With the nominal value of the new shares issued, you debit capital reduction and you credit share capital. Effectively, I hope you are seeing, effectively, you are reducing the capital by how much? If you take this second approach, originally we had a share of 20 million, we cancelled them, now we are replacing them with shares of 18. Effectively, we are reducing the capital by 2 million. Because you are just cancelling 20, replacing it with 18. So effectively from the capital, you are reducing it by 2 million, which is the same as being told, just being told, write off 1 shilling per share. So whichever approach the examiner would use, somehow you are still going to reduce the capital of the company, So that's number one, which I have told you, with amount written off on share capital. You go debit share capital, you credit this account we have called capital reduction. Number two, in our group of stakeholders, we have those debenture holders. We ask them, and the creditors, we ask them, what can you do for us? Remember, those are liabilities. For the shareholders, for the debentures, and the creditors, they are liabilities. So they said they are willing to write off whatever it is. So with amount written off on liabilities, I'm discussing number two now. With amount written off on liabilities, whichever the liabilities, we know liabilities are always a credit balance. So whatever amount the question tells you to write off, you will have to debit that liability account, and of course, you credit capital reduction. That's number two, which says with amount written off on liabilities, you debit the liabilities and you credit capital reduction. That's number two. Number three, as a group of stakeholders, when we met, we agreed, why can't we also revalue some of the assets, maybe downwards? Let us reduce some of the value of the assets. Maybe they are overstated in the books. Let's revalue some of the assets downwards. Maybe machinery, we reduce it by this much, furniture, we reduce it by this much, and so on. So that we help this company to eliminate the accumulated losses. So our entry number three says, with amount written off on assets, you will go and credit the assets. Don't forget, assets are always a debit balance. So whichever the amount or whichever the assets, go to that asset account. It has a balance brought down on the debit, whatever it is. Now you credit that account and you debit capital reduction. With amount written off on assets. That is our entry number three, which says with amount written off on assets, you credit assets and you debit capital reduction. Good. That's number three. Number four, as a group of stakeholders, of course, we could have agreed, fine, before I even talk about our stakeholders, I told you, the aim of reconstructing a company is to help this company to eliminate the accumulated losses. The aim of reconstructing a company is to help the company to eliminate the accumulated losses from the books of the accounts. So anytime you are reconstructing a company, it is obvious the accumulated losses that the company has must be eliminated. So that is our step number four, which says with accumulated losses written off. If you go to the P&L account of that company, remember it has been making losses. So when you go to the P&L account of that company, you will find that they have a retained loss. And that retained loss is always a debit balance. Losses are always a debit balance. Good. Now, and so we are saying this loss must be eliminated. We don't want to keep reflecting in our books anymore. Accumulated losses, they must be removed from the books. In other words, they must be written off. So our entry number four says, with accumulated losses written off, you will go and credit P&L account and you debit capital reduction. Good. So already so far you can see, this account called capital reduction becomes your operating account. It's our operating account. Good. So that's our entry number 4, which says, with accumulated losses written off, you debit P&L capital reduction, you credit P&L account, you credit P&L account. Good. So that's our entry number 4. Number 5. Now, before I talk about number 5, listen. Before I talk about number 5, listen. This company A, which is reconstructing themselves, they knew you are an accountant. And therefore they called you so that you help them to reconstruct themselves. Now listen. Suppose you want to reconstruct this company as from 31st December 2021. You want to reconstruct that company as from that 2021. So it is obvious, therefore, you will go to that company and collect as much information concerning that company as at that date, so that from there onwards, you now start reconstructing the company. So you will tell them, give me your balance sheet as at 31st of December 2021, give me this information, give me this information, give me this information, give me this information, and so on. Now, suppose in the process of collecting that information, you realize that by 31st of December 2021, this company had a contingent. Suppose you realize that this company had a contingent liability. It had a contingent liability. Of course, at this level, this is not a new term to you. You have heard of what is a contingent liability. And I believe also you can still be able to give me an example of a contingent liability. I believe you should be able to define what is a contingent liability and also to give an example of a contingent liability. Now, for the sake of time, you know, and most students give me this kind of an example. The example they normally give as an example of a contingent liability is a legal case or a court case, some warranties that are still pending, and so on. Now, let's use a simple example like a court case. In the process of you gathering, you are the accountant, you are gathering the information concerning this company. Suppose you realize that by 31st of December, this company has a court case which has not yet been decided. But the lawyer of the company has assessed the scenario and seen that in case the case goes against the company, then as a company, we shall end up paying 2 million shillings as damages. But if the case will go in our favor, then as a company, we may not pay that 2 million. So remember, as at 31st of December, you are either likely to pay that 2 million or you are not likely to pay that 2 million in the future. And whether you are going to pay it or not to pay it will depend on an occurrence that will take place in the future, the judge deciding. Now, so this company as at 31st of December, they have a liability of 2 million. Listen, they have a liability of 2 million, which is likely to crystallize, in the future, depending on the occurrence or non-occurrence of a future event. So, that kind of a liability which is likely to crystallize depending on the occurrence or non-occurrence of a future event. That kind of a liability is what we call a contingent liability. And we are giving an example like a court case. If the case goes against you in the future, you will end up paying 2 million. If the case is in your favor, you don't pay 2 million. No. Therefore, this company has that kind of a liability, which we are calling a contingent liability. So you now know that a contingent liability is that liability which is likely to crystallize in the future depending on the occurrence or non-occurrence of a future event. Now, we have given a court case, for example. But I'm saying now, as you are gathering this information, of course you know, if I go to the balance sheet of this company as at 31st of December 2021, if I go to their balance sheet, I'm not going to see a liability of 2 million. In the balance sheet, it will not be there. But we are likely to pay that 2 million. So in other words, we are saying, normally a contingent liability normally doesn't appear in the books as a liability. We just know as a company that we are likely to pay 2 million. But if you go to the balance sheet, is it in the books? No. So what do you do? That's the point now. What do you do when you are reconstructing this company and you realize that the company has a contingent liability? You are reconstructing this company and you realize that this company has a contingent liability. As a company or a person reconstructing the company, listen now, you are required to crystallize that liability. In other words, make it as a liability officially in the books. Now, before we continue on how to make it as a liability, we said, when you are reconstructing a company internally, I told you all the stakeholders of the company are normally called into a meeting. And I told you one group of stakeholders you will call into that meeting are the preference shareholders. Maybe as a company, we have a 10% preference shareholders, preference share capital of 30 million. 10% preference share capital of 30 million. It is obvious, as a company, we are supposed to pay these preference shareholders their dividend every year of how much? 10% of 30 million is 3 million. So that's what I'm supposed to pay them every year. But you know, we have been making losses. That's why we are reconstructing ourselves. So it is obvious we have not paid them their dividend. We have no profit, so we don't pay dividends. Now listen. Suppose we have not paid them for the last 2 years. 3 million for every year. For 2 years, we owe them 6 million. Who? These preference shareholders. In other words, there is what we are calling preference dividends in arrears. So the question is this. If you go to the balance sheet of this company, will you find that 6 million in the books as a liability? No. In other words, we are saying preference dividends in arrears do not appear in the books as a liability. No. Do not appear in the books as a liability. But as a company, we know we have not paid them for the last 2 years. So what do you do when you are reconstructing a company? Remember, this is a liability that is likely to crystallize in the future, and especially if you have what we call cumulative preference shares. If your company has a 10% cumulative preference share, then they don't forfeit their dividend. Those dividends keep accumulating. So in future, when you make a profit, it will be required you pay them. But we are saying, for now, for the last 2 years, we have not paid them. Is it in the balance sheet as at now? No. It's not in the balance sheet as at now. But do we owe them? Yes. So another example of a contingent liability is what we are calling preference dividends in arrears. Preference dividends in arrears. And most of your past paper questions at this level of section 6 or advanced financial reporting, most questions use it as an example of a contingent liability. Somebody saying something. Laplace solution, good. Sawa. I don't know why you are saying good. I hope you are following. Laplace solutions, I hope you are following. You have commented and you are saying good. I don't know what you are saying. I hope you are commenting and saying you are following. Are you getting something? Say yes. I want to know. Maybe you are commenting. I don't know what you are saying. I hope you are getting something. You have said just good. I hope you are following. Solutions, you have said Lapsen or Laplace. Comment back and say whether that's what I'm interpreting to mean, whether you are saying you are following or you are okay. Okay, so let me continue. So I was saying this. Listen, that our company has not paid preference shareholders their dividends for the last 2 years. If you go to the balance sheet, will you find the 6 million? I've told you, no. I've told you, oh, okay, so fine, I'm getting. So you are saying nice lecture, I am following, thank you. You are saying nice lecture, I'm following, thank you. Now, listen now. So we are saying, as a company, we owe them 6 million. But if you go to the balance sheet, you can't see that 6 million. Now that we are reconstructing the company, that 6 million called preference dividends in arrears should be crystallized. So the question is, how do we crystallize a contingent liability? Good. So to make it a liability, you will come and debit capital reduction, and you will credit that account called contingent liability, whichever is that contingent liability. Let us assume that specifically we know it's preference dividends in arrears, because we know it's preference dividends. So you will debit capital reduction and you credit preference dividends in arrears. Preference dividends in arrears, whatever it is, that is capital reduction. Good. So that's our entry number 5, which says, with any contingent liability arising, e.g., preference dividends in arrears, you debit capital reduction and you credit that contingent liability. Listen, some questions go further and they tell you that the dividend or the contingent liability was paid for immediately. The moment we decide to start reconstructing the company, first thing we did is to capitalize it, make it now as a liability, which is now in the books as a liability. Then the stakeholders decided to pay for it immediately. So whenever a contingent liability is paid for immediately, we are saying you debit that contingent liability now and credit bank, whichever the contingent. For now, we are only using preference dividends in arrears, which I have said most of your past paper questions use it. Okay? Now, so that's step entry number 5. Number 6, and the last one. So we are saying here, number 5 is with any contingent liability arising. That's number 5. Number 6, and the last one is this. Once you implement the scheme that the stakeholders have come up with, once you implement that scheme, normally this account called capital reduction should be self-balancing. In other words, we normally use this account called capital reduction just to help you to implement the scheme of internal reconstruction. We only use it to help you implement the scheme. But I'm saying, once you have implemented the scheme, normally these accounts should be self-balancing. But there are times when you realize that there is a balance. After implementing the scheme, there is a balance in this account. And in most cases, that balance could be on the debit side of this capital reduction. And so we are saying number 6 is, with any balance remaining in the capital reduction account, that balance, we normally consider it as a capital reserve. With any balance remaining in the capital reduction account, that balance should be considered as a capital reserve. So what do? You debit capital reduction and you credit capital reserve. That's how we treat the balance in case there is a balance in that account. So I've gone through the 6 official accounting entries for internal reconstruction. I've gone through the 6 official accounting entries for internal reconstruction. Number 1, we have said, with amount written off on share capital. Whatever it is that you're writing off, you go debit share capital and you credit capital reduction. Number 2, with amount written off on liabilities, you go debit the liabilities because liabilities are always a credit balance. Debit liabilities, credit capital reduction. Number 3, with amount written off on assets, you credit the assets, you debit capital reduction. Number 4, with accumulated losses written off, you debit capital reduction, credit P&L. I've told you, accumulated losses are always a debit balance. So when you go to the P&L account of this company, you will find it as a debit. And because it must be eliminated, you credit P&L account and you debit capital reduction. An important point here, listen, an important point here is this. Normally, in most of your past paper questions, the examiner will never remind you to write off those accumulated losses. Normally, the examiner will not remind you to write off those accumulated losses. What he does is, he gives you the other items in the scheme. He talks about share capital, the examiner will talk about liabilities, maybe assets and so on. But he doesn't remind you to write off the capital. Listen. So whether the examiner reminds it to you, whether the examiner reminds that to you or not, you should remember, what is the aim of reconstructing a company? The aim of reconstructing a company is to help the company to do what? We said is to help the company to eliminate the accumulated losses. To help this company to eliminate the accumulated losses from the books, so that we start our activities in a more attractive and profitable manner. Listen. So whether the examiner reminds you or he does not remind you, it is your responsibility to remember that losses, accumulated losses, must be written off. I've told you, most of your past paper questions don't remind you. They don't remind you. They just keep quiet. But they talk about share capital, they talk about liability, they talk about that contingent liability, they talk about others, but they don't talk about accumulated losses. Once you're through with implementing the scheme that the question will give you, before you start balancing the accounts, you should remember that accumulated losses must be written off. The accumulated losses must be written off. Good. Now, let's go now back. That's our entry number 4. That with accumulated losses written off, I told you debit capital reduction, you credit P&L. Number 5, I've told you with any contingent liability arising. With any contingent liability arising, e.g. preference dividends in arrears, you have to crystallize it. How? By debiting capital reduction and crediting whichever is that contingent liability, which in our case we are assuming it's preference dividends in arrears. And I've told you, if it is paid for immediately, you debit contingent liability and you credit bank. That's number 5. Number 6 and the last one, with any balance remaining in the capital reduction account, with any balance remaining in the capital reduction account, being a capital reserve, you debit capital reduction and you credit capital reserve. Good. Now, before we develop the topic, I want to take you back to some of those entries. Number 1, we agreed with amount written off on share capital, which we were assuming to be 2 million. I had to debit share capital, I had to credit capital reduction. Tell me this. When we called in the ordinary shareholders and they said they are willing to write off 2 million, and as a company we went and debited, listen, as a company we went and debited share capital by 2 million and credited capital reduction by 2 million, the question is, to us as a company, are we gaining or are we losing? I am saying, is that a gain to the company or is it a loss to the company? I want you to chat and tell me whether you think it's a gain or it's a loss. Listen, we called in the ordinary shareholders and we asked them, what can you do for us? They said they are willing to write off 2 million. So as a company, we debited share capital, we credited capital reduction. Question is that a gain to the company or a loss to the company? To the company. So I want you to chat and tell me whether you think it's a gain or you think it's a loss. Chat and tell me whether you think it's a gain or you think it's a loss. In your chat, put there, I see. I am waiting. Somebody says it's a gain. Good. Another person, I don't know whether it's right. We shall conclude. Another person, good. It's a gain. Why is it a gain? Let me explain now. Initially, we owed the ordinary shareholders, we owed them 20 million. And now they are willing to write off. Now they are willing to write off 2 million. So if they are willing to write off 2 million, as a company, we are reducing what we owe to them, what we owe to the ordinary shareholders. So to us as a company, that's a gain. Good. That was number 1. Number 2, we said, with the amount written off on liabilities, whether debentures, creditors, and so on, we agreed. The double entry is you debit the liability and we said you credit capital reduction. We said you debit the liabilities, we said you debit the liabilities and you credit capital reduction. That was number 2. So the question again is this. We called in the debenture holders. We told them, yes, we owe you 40 million. And they agreed to write off 4 million. So with that 4 million, we had to debit debentures and credit capital reduction. Again to you, Is that a gain to the company, or do you think it's a loss to the company? Do you think it's a gain to the company, or do you think it's a loss to the company? Again, I want you to chat. Do you think it's a gain to the company, or do you think it's a loss to the company? We called the debenture holders, and they said they are willing to write off 4 million from their capital. So we had to debit share capital, and we had to credit capital reduction. So the question is, to us as a company, is that a gain or is that a loss? Is that a gain or is that a loss? I want you to chat and tell me. We called the debenture holders, and they said they are willing to write off 4 million. So the question is that a gain to us or a loss to us? It's obvious, again, it's a gain. Because again, we are reducing what we owe to them. We are reducing what we owe to them. So again, that's a gain to the company. Number 3, we agreed as a group of stakeholders that we reduce the assets of the company. Machinery, furniture, this much, and so on. So with what we are writing off on the assets, we went and credited the asset, and of course we debited capital reduction. We went and credited the asset, and we debited capital reduction. It is obvious, I hope you are seeing, that is a loss to the company. That is obviously a loss to the company. Why? Because we are reducing the value of our assets. We are reducing the value of our assets. Good. Now, number 4. Let me jump to number 5 first. Number 5. With any contingent liability arising, we said you have to crystallize it by debiting capital reduction and crediting that contingent liability. In other words, I told you, make it a liability in the books from now. It was not in the books, now make it as a liability officially. So the question is this: by you crystallizing that liability, are we gaining as a company or are we losing as a company? I hope you can notice that it's obvious that is a loss. Why? Listen, before reconstruction, we did not have that liability in the books. The dividend that we owe to the preference shareholders, it was not in the books at all. We were assuming 6 million. But the moment I start reconstructing the company, I have to crystallize that liability of 6 million. How? By debiting capital reduction and crediting contingent liability. Which automatically means, listen now, which automatically means that before reconstruction, we did not have a liability in the books. After reconstruction, we shall now have a liability in the books as a company. It means, therefore, that our liabilities are increasing as a company after reconstruction. Obvious, that's a loss to the company. Listen carefully now. So even from those 4 entries, you should notice a pattern. From those 4 entries, I hope you have noticed a pattern. What is that pattern? That every time the company made a gain in the process of reconstructing itself, that gain has been credited in the capital reduction. I hope you have noticed that. Anytime the company made a loss in the process of reconstructing itself, you realized that loss has been debited in the capital reduction. Okay? That's what you have realized. From those 4 entries alone, anytime we made a gain, it had to be credited. Anytime we made a loss, it had to be debited. Like, for example, when we wrote off the capital, we made a gain. When we reduced our liabilities, we made a gain. When we wrote off the assets, we made a loss as a company. When we crystallized the liabilities, our liabilities going up, it's a loss to the company. Good. Now, listen carefully. I have taken you through that because of this. There are some questions in your past papers which give you many other items in the scheme for you to implement. But some of them are not among these 6 official entries that I've given you. But you realize that in case you implement that item, I have told you there are some questions that give you other items not among the 6 in the scheme. But suppose in the process of implementing that item the examiner has given you, maybe it's not 10, not 11, not 12, whatever it is, suppose you realize that in the process of implementing that scheme, our company will gain. Our company will gain. Where will I take that gain? That's the question. We are now saying that gain should be credited in the capital reduction. For example, assuming note number 10 in the question tells you share premium is to be written off. Share premium is to be written off. You know, obviously, share premium is always a credit balance in the first place. Share premium is always a credit balance. 2, you also know share premium is an amount that belongs to shareholders. It's part of equity, and therefore it's an amount that normally belongs to shareholders. So if the question tells you to write off that share premium, it is obvious therefore you will make a gain. Why? Because you are reducing what belongs. You as a company, you are reducing what belongs to the shareholders. It belongs to them, and therefore if we are writing it off as a company, we are gaining. So you will debit that share premium account, and of course you will credit capital reduction. Good. Now, share premium is one form of a reserve. It could be any other reserve. Maybe the question tells you general reserves to be written off, or maybe revaluation reserve to be written off, or whichever other form of reserves. Share premium being one of the reserves, we are saying it could be any other reserve. Whether it's your told share premium, or your told general reserve, or maybe it's a revaluation reserve in the question. If it's to be written off, we are saying as a company you are gaining. Next, what if you go to note number 7 or 20, number 5 or whatever, and you realize something like this? You're told during the reconstruction process, the company had to spend 2 million shillings for reconstruction. In other words, the company incurred what we call a reconstruction cost. The company incurred a reconstruction cost of shillings 2 million. It is obvious that reconstruction cost is not among the 6 official entries that we talked about. No. But now you realize, as a company, we are incurring a reconstruction cost. So you ask yourself, we are spending 2 million to reconstruct that company. Is it a gain to the company or a loss to the company? It's obvious it's a loss to the company. And therefore, we agreed any loss that you make in the process of reconstructing a company, that loss should be debited in the capital reduction. That loss should be debited in the capital reduction. So you will debit capital reduction and you will credit bank because you are spending 2 million shillings. You will debit capital reduction with that amount of the reconstruction cost, and of course you will credit bank. Now listen. So I've taken you through how to implement a scheme of internal reconstruction. How to implement a scheme of internal reconstruction. Good. Now, of course, I'm not going to give the notes because this is not a normal class. I was just putting it as a free class to promote the class. So I'm not going to give the notes. Otherwise, in the normal class, I normally give the notes. I dictate the notes. But for now, because it is just a promotional class, I'm not giving the notes. But I am hoping that you have followed what we have said. Okay? If you find you would want to summarize your own notes, you can go back to the same link. Listen, if you feel you want to summarize your own notes, you can go back to the link that I've given you. Click on it again. The video will open after this or any other day, and you'll be able to watch that video again. If you feel that you would want to watch the class again, listen. At the same time, because it is through the YouTube, I would ask you also to subscribe to my YouTube channel. You can also subscribe to the YouTube channel as you are listening to the video, because it will be in the YouTube. Okay? So please subscribe to my YouTube channel where it will be posted after this, Now, that is how to implement or to undertake, listen, how to undertake an internal reconstruction question. How to implement that internal reconstruction. Now listen, just to develop the topic slightly, there are some questions from your past papers. Which test you under this topic of internal reconstruction in two ways. One way, still under internal, don't forget, still under internal reconstruction. One way is where the examiner gives you a scheme, of internal reconstruction. They give you a scheme of internal reconstruction. The question tells you, number one, ordinary shares to be reduced by 5 shillings. Number 2, preference shares to be reduced by 10 shillings. Number 3, assets to be revalued to their fair values as follows, so that some of them will give you a loss, whatever the assets will be revalued. And they tell you preference dividends were 2 years in arrears. You obviously will know that's a contingent liability. Then they tell you, maybe number 5 or number 7, reconstruction cost of shillings 2 million was incurred, so on. Then they tell you somewhere share premium to be written off. So that's one way the examiner can set a question on internal reconstruction, where he gives you a scheme of internal reconstruction. Yours as a student is just to implement that scheme by preparing that capital reduction. There are other questions whereby the examiner would start by asking you to come up with your own scheme. Come up with your own scheme of reconstruction. Yani, design one. So he gives you information of the company. He just gives you the information of the company. Remember I told you, whenever you are reconstructing a company, you will go to that company and collect as much information as possible. This company has called you to help them reconstruct. So it's your responsibility to collect as much information as possible. So then once you collect that information, now you come up with a scheme of internal reconstruction. So what we want to answer now is this. How did this company, or how did this question tell me that ordinary shares are to be reduced by 5 shillings, preference shares to be reduced by 2 shillings? How did they come up to know that it will be written off by 5 shillings? How did they come to know that preference will be written off by 5.7? How did they come to know that machinery will be reduced by this much in value? This will be the amount to be incurred and so on. In other words, how did they come up with a scheme of internal reconstruction? So some questions start by telling you to suggest a scheme of internal reconstruction. Once you suggest a scheme, then they now tell you, number B, part of the question, prepare the ledger entries or show the ledger accounts to record the above. Number C, balance sheet after reconstruction. That's another way. So some questions just give you the scheme. Then they tell you, number A, ledger entries or ledger accounts. B, balance sheet after reconstruction. That's okay. Give you the scheme. Yours is to implement and come up with a balance sheet after reconstruction. Others tell you, first design your scheme. They give you the information. The question will give you the information concerning the company. And all from that information, now you come up with your own scheme. So the question is, how do you design a scheme? In other words, how do we suggest? What are the steps of suggesting? Or in other words, designing a scheme of internal reconstruction. How do you come up with a scheme of internal reconstruction? That's what we want to talk about. I may not be able to finish the discussion of this, but I just want to give you an overview of how you go about it. An overview. I may not be able to finish because today it was just a promotional class. Now, as a person appointed to reconstruct this company, you have to come up with a scheme. So what are the steps that you will follow in designing a scheme of internal reconstruction? So there are some steps you have to follow. There are some steps you have to follow in designing a scheme of internal reconstruction. The first thing you have to do, or step number 1, is you start by determining what is the total loss to be written off. Cumulatively, what are the total losses that this company will suffer in the process of reconstructing themselves? So you determine, that's step number 1, determine the total loss to be written off. Determine the total loss to be written off. That's step number 1. So how do you determine that? From the information concerning that company, you will go through it and see, by implementing this thing, the company will suffer loss. The company will suffer loss. The company will suffer loss from this and this. In other words, identify some of the losses the company will suffer in the process of reconstructing themselves. Obvious, we have identified a few. Like what? Reconstruction cost. So unasoma somewhere, unaona, maybe they are telling you the company will spend 2 million to reconstruct themselves. What other losses did we have mentioned already? Maybe assets being reduced in value. An asset which was having a book value of 10 million, now after reconstruction, it will go back into the books at 6 million. That's a loss. So you identify, and many other losses. But I'm just saying, identify the losses that this company will suffer in the process of reconstructing themselves. I also told you, writing off the accumulated losses, they accumulated in the P&L account. That's already a loss on its own. So in other words, just identify the losses that the company will suffer in the process of reconstructing themselves. Then you also ask yourself, are there some gains that as a company we could make in case we reconstruct ourselves? In case we reconstruct ourselves. Maybe yes. If there are some gains that as a company we can make in the process of reconstructing ourselves, use those gains to reduce the losses. Use those gains to reduce the losses. For example, I told you, share premium is to be written off. Share premium is to be written off. Now, so we are saying, if you are told share premium is to be written off, I have already told you somewhere when we were looking at the double entries, it's already a gain. Two, I also told you, maybe some liabilities will be reduced in value. I told you that's a gain. So you identify the gains that this company will make in case they reconstruct themselves. So you identify the losses, get the gains, get the net of the two. Whatever is the net, that becomes what we are now calling total loss, to be written off. Total loss to be written off. That's step number one. For purpose of illustration, let us assume the loss that you got is 5 million. For purpose of illustration. Yes, we have. Who is this asking? Daniel Mwanza. Yes, we tackle past papers as we are doing the questions. It's only that now I have to teach first, but once I teach, we have to do a question. So Mwanza or Daniel, it's true. Every time we teach a normal class, after I've taught a topic, we normally do a question from the past papers. Okay, Mwanza? Are you okay now? Have I answered you? Mwanza, you're asking, in the normal class, do you have cases where you tackle past papers? Yes. In fact, by now, listen, in fact, by now, I would not have gone to this second approach. Listen, I would not have gone to this second approach of suggesting a scheme. I would have gone to the question of past papers and done one question where you are given a scheme. Okay, Mwanza, I hope you are following. I've said, in such a case, in a normal class, I would not have gone to this second part of the topic. Remember, I've told you there are two ways of reconstructing a company internally, where you are given a scheme and where you are not given a scheme. We have taken you through the accounting entries for internal reconstruction, where you have been given a scheme. So if I was to do a normal class, which I have done already, I would now have told you from the past papers, let's do this question, this question. If you have already done this, listen, you can tackle, because I think in our normal class we did November 2016 question. That question 3, yes, if you want to look for it and you have past papers, you can look for November 2016 question 3. We did it in the normal class. In that question, you were given a scheme. Yours was just to implement the scheme. I think it was question 3. It was question 3, but November 2016. That one I remember. If you go to the November 2016 paper, you will find a question on internal reconstruction, where the examiner has given you a scheme, and in that scheme there were 8 items from number 1 to number 8. So ours, they told you number A, prepare capital reduction. Number B, prepare balance sheet after reconstruction. Then from there, I now discussed this second approach, where you are to suggest a scheme of internal reconstruction. We went through the 4 steps. There are normally 4 steps. Once we go through the 4 steps and we finish, I did another question from the past papers, again, that require you start by first designing a scheme of internal reconstruction. So Mwanza, I hope you have been helped. If you have your past papers, you can attempt now. Question November 2016, you should be able to attempt, because I've taken you through the accounting entries, and I've also taken you through where the examiner does not give you a scheme. No, I've taken you through other transactions which are not among the 6, but you realize from the question that that thing the examiner is giving me will make me gain as a company. That gain, we have said, must be credited in the capital reduction account. Then I've told you, if you realize that the company will suffer loss, that loss should be credited in the capital reduction, should be debited, in the capital reduction account. So from that question of November 2016, of course, if you will join our normal class, I'll give you this video for that, because once you join, I give you the videos of the previous classes that we have already taught. Like, for example, now we have done this topic in the normal class. We have done this topic in the normal class. That's why I'm hoping there are no normal class in this group, because they have already done this topic. They have already done this topic. So if you will join, listen, if once you want to join the class, then I can give you the videos of those classes. I can give you the videos of those classes, because we have already done the topic internal reconstruction. Good. Yeah, yes. You are saying you joined today. You will get them. In fact, Maureen, I've already emailed, given you the videos. Check in your WhatsApp. Maureen, I've already given you. Check in your WhatsApp. Yes, I can remember you joined today. Check in your WhatsApp. Have you seen them? Have you seen them? Maureen, I want the answer. Maureen, I want an answer. Because you have said you have just joined today. I've said, I think when you joined, I forwarded those videos to you in your WhatsApp. Okay, let us be continuing in the meantime. Okay, you go. You have agreed. Thank you. So watch them. Maureen, watch them, because I forwarded them to you the moment you joined. Okay, fine. Now, let's continue. Ati Maureen, no. Where? You have not opened your WhatsApp. Maureen, you joined this evening. And I know I forwarded. In fact, you told me, send me the videos of the previous classes. And I did. Okay, we shall talk after class. We shall talk after class. But open your WhatsApp. You will see them. Okay, fine. So let's continue. So I was saying this, that in case you are not given a scheme and you are to design one, what are the steps that have to be followed in designing? Yeah, to check later, fine. To check later, fine. So that you don't open and you close this one. Okay, fine. You check later. Because if you open now, it will close the one we are doing currently. Thank you. So, okay, fine. So I was saying this. If you are not given a scheme and you are to design one, there are 4 steps that must be followed. Number 1, determine the total loss to be written off. Determine the total loss to be written off. How do you determine that total loss? By identifying the losses that the company will suffer in the process of reconstructing themselves. 2, identify the gains that the company will make in the process of reconstructing themselves. Get the net of the 2, and that will give you the total loss to be written off. Good. Number 2, step 2 now. Before I talk about step 2, you will remember I told you, when it comes to internal reconstruction, I told you all the stakeholders of the company are called into a meeting. The stakeholders, these include ordinary, these include preference, these include debenture holders, creditors, and so on. Now, we have to write off a loss of 5 million. We have to write off this loss of 5 million. So the question is this now. Listen. Who among these stakeholders, who among them should we request that they suffer this loss of 5 million? As a company, should we request the ordinary shareholders? Should we request the preference shareholders to suffer that loss of 5 million? Should we request the debenture holders? Or should we request the creditors? Who among the stakeholders of the company should be requested to suffer the loss in our step number 1? Now, to know who is to suffer that loss, listen, there is no way you can tell somebody among them, whoever, there is no way you can tell somebody to suffer that loss in the process of the company reconstructing themselves. Listen, if they know if they know that if they go to court and ask for the company to be liquidated, remember, we are not liquidating our company. We are reconstructing our company. We are not liquidating the company. We are reconstructing the company. But we want to ask ourselves this. Who is this stakeholder who, even if he goes to court and asks for the company to be liquidated, that stakeholder will still lose? Remember, whenever a company is liquidated, normally assets of the company are sold. And then, normally, liabilities are paid in order of priority. So we want to know who among the stakeholders of the company, even if they go to court and ask for the company to be liquidated, and the company is liquidated, the assets will be sold, the liabilities will be paid in order of priority, and by the time the money gets finished, maybe according to their order of priority, they will not have been finished, they've been paid. Yani, hawatakuwa wamefikiwa in the order of priority, but the money is finished. So these are the guys you tell them, please accept to suffer that loss of 5 million. Why? Please accept to suffer the loss of 5 million in the reconstruction of the company. Why? Because even if you go to court and ask for the company to be liquidated, this is how the assets will be sold, and these are the liabilities that will be paid in order of priority. But down here, you will not have been reached, and yet the money is got finished. So you tell them, even if you go to court and ask for the company to be liquidated, you will still suffer. So why can't you, as a stakeholder, why can't you accept that you suffer that loss of 5 million with the hope that we shall make profit in the future, and you will participate in that profit? So it is that kind of a stakeholder that we want to know. Who is this? Is it the ordinary? Is it the preference? Is it the debenture holders? Who, even if they go to court and ask for the company to be liquidated, they will be paid very little of what the company owes them, or they will get nothing at all. Those are the guys we want to tell them it doesn't help you asking for the company to be liquidated. You will still lose. So please accept that we reconstruct the company, not liquidate it. We reconstruct the company by you suffering that loss of 5 million. So step 2, listen, is only to help you to identify that stakeholder. But we are not liquidating the company. But we shall come and do step 2 by saying, suppose the company is liquidated. Suppose, not that you liquidate, suppose the company is liquidated. So if you say suppose the company is liquidated, then you will now be required to prepare, you will prepare now what we call a distribution statement. You prepare a distribution statement of what? Of the sales proceeds from the sale of assets. You prepare a distribution statement of the sales proceeds from the sale of assets on the assumption that the company is liquidated. So, if the company is liquidated, machinery will be sold for this much, furniture this much, this much, this much. Good. Then we start paying the liabilities in order of priority. I know you know that list, priority list, because you have done company law, and that means you did a topic called winding up. And you know which liabilities are normally paid in case a company is liquidated and in what priority order. You know them. Okay? So, again, because of time, I need to ask myself, what is the first liability whenever a company is liquidated? Which is this first liability that must be paid first? Normally, the first liability that must be paid first whenever a company is liquidated, that liability is called the secured liability. Any secured liability is normally paid first. It could be you had a loan which was secured on land. So you will come and say here, our land will be sold for 10 million. But maybe we used it as a security for the loan. So you minus the secured loan. Maybe the loan was 3 million. So utabaki na net ya 7. So that secured liability, of course, it is normally netted against the particular asset, which I've illustrated. So that being the first liability that is paid, and I'm assuming you have paid it, and money is still remaining, then what next? Should be paid next. You normally pay what we call liquidation expenses. We normally pay what we call liquidation expenses as the next liability in order of priority. After you pay the liquidation expenses and money is still remaining, then you normally pay what we call preferential creditors. We normally pay what we call preferential creditors. Once you pay the preferential creditors and money is still remaining, you normally come and pay next, in order of priority, you normally pay what we call debentures on a floating charge. Debentures on a floating charge. Or any other liability, not only debentures. Most questions have it as debentures, but it can be any other liability that is secured on a floating charge. Could be bank overdraft, it could be your loan, it could be your debentures that were secured on a floating charge. You minus. Assuming you paid and money is still remaining, you now come and pay what we call unsecured creditors. Unsecured creditors. Now, once you pay the unsecured creditors and money is still remaining, what do you pay next? But before we pay the next one, listen, when I say unsecured creditors, in the language of liquidation, I am not talking of the trade creditors alone. When I'm talking of unsecured creditors, I am not referring to the trade creditors alone. No. I am referring to any other liability that does not have security. Any other liability does not have security, all of them, we normally classify them under unsecured creditors. So in the language of liquidation, any liability that does not have security is called unsecured creditors, or in other words, unsecured liabilities, but in the language we call them unsecured creditors. After you pay the unsecured creditors, which could be bank overdraft, it could be a loan that you have that does not have security, all that still under unsecured. It could be the normal trade creditors themselves. That's what we classify. Assuming you pay the unsecured creditors and money is still remaining, then what should be paid next? A time has come now for you to pay the shareholders what is due to them. Suppose your company has two kinds of shareholders. One, preference shareholders, and two, ordinary shareholders. By now you know that normally preference shareholders rank first in the order of priority. They rank first. But then again, when it comes to preference shareholders, there are two things that you could be owing to them. One is their dividend in arrears, and two, their capital, that is share capital. So the question is, what should I pay them first? Should I pay them the dividends that are still in arrears, or should I pay them their capital first? In order of priority, you are supposed to pay them their dividends in arrears first. So you come and say your preference, dividends in arrears. Suppose you pay the arrears and money is still remaining, then you pay them their capital. So you come and say preference, share capital now. Whatever it is, then whatever now remains after paying the preference share capital, all that which remains normally should go to the ordinary shareholders. Normally that should go to the ordinary shareholders. That should be paid to the ordinary shareholders. They take everything that remains. They are the last people to be paid. Now, that is the order of priority. But suppose, listen now, from your question, after you paid the arrears here, you came and paid the preference shareholders, whatever it is. And after paying them, let me assume you went to the balance sheet of this company and you find the company had 200,000 preference shares of shillings 10 each. And the company also had 400,000 or 600,000, let me put it 600,000, 200,000 shares of 10 each, that's coming to 2 million. Then ordinary is 600,000 ordinary shares of 10 each, that comes to 6 million. Now listen, that's in the balance sheet. But I'm assuming after paying the arrears, ukabaki na how much? Let me assume ukabaki na 3 million. Ukasema, okay, after paying the arrears, what am I paying next? Preference share capital. Ukaenda kwa balance sheet ukapata we owe them 2 million. So you paid them their 2 million. Obvious, you remained with a balance of 1 million. That 1 million, I told you, all of it, give it to the ordinary shareholders so that you remain with nothing. But I now am realizing from this balance sheet that we owe the ordinary shareholders 6 million. But if they go to court and ask for the company to be liquidated, this statement will show them They can only get 1 million after everybody else has been paid. They can only get 1 million. So it is obvious, listen, we cannot ask the preference shareholders to suffer the loss that we got in step 1. Why? Because they will know that in case they go to court and ask for the company to be liquidated, they will be paid their 2 million and even their arrears. Then we are asking, can we ask the debenture holders? No. They know that in case the company is liquidated, somewhere there they will be paid. Can we ask the creditors to suffer the loss? No. Why? Because they know if they go to court and ask for the company to be liquidated, they will be paid. Now, so we are now realizing from this illustration that the only people, I'm not saying always, but from this illustration, the only people who will suffer in case the company is liquidated, they are the ordinary shareholders. From this illustration, they can only get a maximum of 1 million in case the company is liquidated. But we owe them 6 million. So if they go to court, they will still lose the 5 million because they can only get 1 million. So from step 2, now listen, from step 2 now, you can easily conclude who among the stakeholders should suffer the loss in step 1. From this illustration, we are concluding it is the ordinary shareholders. It is the ordinary shareholders. Why? Because we owe them 6 million, but they can only get 1 million in case the company is liquidated. So we approach them and tell them, okay, fine. Please, you ordinary shareholders, accept to suffer a loss of 5 million, which we got in step 1, with the hope that we shall make profit in the future, and you will be able to participate in that profit. So please accept to suffer that loss of 5 million in the reconstruction process. Because we tell them, even if you go to court, this is the process that will be followed, and you still lose. Why go to court and ask for the company to be liquidated? Just accept reconstruction with the hope that we shall make profit in the future. Good. Now, having concluded who is to suffer the loss from step 2, now you go to step 3 now. Now you go to step 3. And step 3 now is to determine what we call the loss. Determine the loss. This is determine the loss reduction per share. Determine the loss reduction per share. So we want to know, yes, the ordinary shareholders are going to suffer that loss of 5 million. From their capital, we should write off how much per share. So we determine what we are calling the loss reduction per share by taking that total loss. You now divide that by number of shares. To determine the total loss per reduction, to determine the loss reduction per share, you normally have to take the total loss, you divide that by the number of shares. I have not written divide by number of ordinary. It could be preference, it could be ordinary. That's why I'm just saying by the number of shares. But from our illustration, we are saying it's ordinary from our illustration. Therefore, the loss was 5 million. We divide that loss of 5 million by the number of shares, which we were assuming our company has shares amounting to 600,000. So what shall we recommend? What shall we recommend as the amount to be written off per share? It will be 5 million. Let me divide 5 million divide by 600. That comes to something like 8.3. That is step 3. Now you go to step 4 and the last one, where you now suggest a scheme. suggest a scheme of internal reconstruction. Now listen, what is it that should be included in that scheme? One of the things that must be included in that scheme is whatever you got in step 3. Whatever you got in step 3, that must be part of the scheme. For example, you will come and say, yeah, number 1, ordinary shares to be reduced by 8.3 per share. That's one of the things in the scheme. Good. Then the question is, what else should we include in the scheme? To determine what else you should include in the scheme, that is number 2, number 3, number 4, number 5, and so on. Listen, you have now to go back. You have to go back to step number 1. You have to go back to step number 1. Anything that we used in the determination of that 5 million in step 1 must be part of the scheme. So you go back to your step number 1, and anything you used in the determination of that loss of 5 million should be part of the scheme. We did not complete step 1, but let me now try and complete it first. I just told you, identify the losses, and I told you, identify the gains. But what are some of the losses the company could suffer? What are the gains the company could make? So that now you know which items to include in the scheme. Now, I gave you a few examples. 1, let me just identify. Your company has an asset which before reconstruction, it had a book value of 5 million. But after reconstructing this company, that asset will go back into the books at 4 million. It is obvious, as a company, we shall suffer loss of that 1 million. So in other words, we are saying any decrease in value of an asset, that will make your company to suffer a loss. What if you had another asset which was worth 5 million in your books before reconstruction, but after reconstruction, it will now go back into the books at 6 million? It means it will go back into the books at a higher value than it was in our books. As a company, we are gaining. One of the gains that you as a company could make is when there is increase in value of an asset. Good. Another one. What if these now are not assets? What if these are liabilities now? So, one of your liabilities was in the books at 5 million, but after reconstruction now, it will go back into your books at 4 million. It is obvious our liability is reducing after reconstruction. We had a liability of 5 million before reconstruction. Now after reconstruction, it will be worth 4 million. As a company, we are gaining. So any decrease in value of a liability, that will automatically make you to gain. Another liability was worth 5 million before reconstruction, but now it will go back into the books of the company after reconstruction at 6 million. That automatically means as a company, we are gaining. No, we are losing. Sorry, this is a liability. We are losing. It was worth 5 million before reconstruction. Now it's worth 6 million. That means as a company, we are losing. So any increase in value of a liability, that makes you to suffer a loss. The other example of losses I talked about was maybe you are going to incur a reconstruction cost of maybe 2 million to reconstruct your company. That's a loss to the company. I also told you the accumulated losses themselves must be written off. You know, losses are always a debit balance. And I've also told you, and you know, these are retained losses. In other words, they are reserves. Listen, they are reserves, which is a negative reserve. It's a retained loss, a negative reserve. And as a company, we have to write it off. So as a company, this is not our money. It's money that was supposed to be given to shareholders. Retained losses and other reserves are money that belongs to shareholders. So if as a company, we are the ones to write off the loss, then as a company, we are losing. Because that was not our amount, but it is required that we must write it off. So as a company, when you write off the accumulated losses, you are losing because it was the shareholders to take it over. But now we are the ones writing it off. So as a company, that's a loss. So another component of losses are what we are calling accumulated losses. Good. If there were positive reserves, like I told you, share premium, general reserve, revaluation reserve, those are again reserves that have to be written off. In case you are reconstructing a company, reserves should be written off. And we said, when you're writing off things like share premium, general reserve, and so on, you are gaining. Why? Because this was money belonging to shareholders. And as a company, we are writing it off. In other words, we are reducing what we owe to the shareholders. That's a gain. So among the gains, we can say here, reserves to be written off. Reserves to be written off. Whatever reserves, could be share premium, general reserve, revaluation reserve. Finally, I also told you that in case your company has a contingent liability, e.g. preference dividends in arrears, I told you, before reconstruction, it was not in the books. But the moment you start reconstructing the company, we said that contingent liability should be crystallized. By debiting, you remember, capital reduction, and you credited contingent liability. Now listen, it means from now onwards, after reconstruction, our company will have a liability which was not there before. So as a company, we are losing. That's a loss. So any contingent liability makes a company to lose. So I have identified for you what are the items that can give rise to losses, what are the items that normally give rise to gains. Decrease in assets, increase in liabilities, any reconstruction cost, all the accumulated losses, and any contingent liabilities. Those are the components that give rise to losses whenever a company is reconstructed. Any increase in assets, any decrease in liabilities, any reserves that are there that should be written off, those are items that give rise to gain. Look at it now. I take you to step 4 now. Now that you know what is in step 1, I told you to suggest a scheme in step 4. One thing that must be part of the scheme is whatever you got in step 3. In our step 3, we said ordinary shares to be reduced by 8.3. So we come to the scheme and we suggest 1, ordinary shares to be reduced by 8.3 per share. 2, we can come and say assets to be revalued. Assets to be revalued. Assets to be revalued to their fair values as follows. Machinery this much, furniture this much, motor vehicle this much, blah, blah, blah. So that through the process of revaluation of those assets, some of them will decrease in value, that's a loss. Some of them will increase in value. That's a gain. Same to liabilities. Liabilities to be revalued to blah, blah, blah. So that when they are revalued, some of them will give me a gain, some of them will give me a loss. If there is an increase in liability, that's a gain, a loss. If there is an increase in liability, that's a gain. Sorry, if there is an increase in liability, that's a loss. If there is a decrease in liability, that's a gain. The other thing we used in step 1 was the accumulated losses themselves, which we said they should be written off. So you come and say to the scheme, accumulated losses to be written off, because they must be written off. Good. Another thing we used in the scheme or in step 1 was the reconstruction cost. So you came and said here, reconstruction cost. You come and say here, reconstruction cost of shillings 2 million or whatever it is to be incurred. That is it. Number 6. You remember we saw that there could be sham premium, general reserve, and so on, which gave us a gain. You can come and say your reserves to be written off. Reserves to be written off. Another thing we used in this step 1 was that contingent liability, you remember, which we gave an example of preference dividends in arrears. So you could come and say here, preference dividends in arrears to be paid in cash. That's what we are saying. Don't forget, in our entry number 5, when we were looking at the accounting entries, our entry number 5 to be same with any contingent liability arising. Here, with any contingent liability arising, we said you debit capital reduction and we said you credit that contingent liability. Then I told you, if it's paid for immediately, you debit contingent liability and you credit bank or cash. Now, so once you do step 1, you do step 2, you do step 3, now you go to step 4, suggesting a scheme. I've told you, what should you include in the scheme? 1, anything you used in you got in step 3, the loss reduction per share. 2, 3, 4, 5, 6, 7, 8 item in the scheme depends with what you used in step 1. Anything that you used in step 1 must be part of the scheme, must be part of the scheme. So, 1, decrease in assets or increase in assets. If it's a decrease in asset, it will give you a loss. If it's a increase in asset, it will give you a gain. So you can say assets to be revalued to their fair values as follows, blah, blah, blah. 2, liabilities to be revalued to their fair values as follows. So that some of them will give you that gain, some of them will give you the loss. Then you can say reconstruction cost of shillings 2 million to be incurred. That will give you that loss. Next, accumulated losses to be written off. That's what you can say. Next, preference dividends in arrears to be paid in cash. That's the contingent liability. That's a loss. Then finally, you come and say reserves to be written off. Good. So that way, you will have designed a scheme. That's how you design a scheme. What I don't want you to forget again is step 2. Step 2, we said, you are only using it not to reconstruct, but to help you, step 2, to help you know who among the stakeholders should suffer the loss in step 1. Who among the stakeholders should suffer the loss in step 1? Is it the ordinary? Is it the preference? Is it the debenture holders? Is it the creditors? For you to know who among them, you need to know who is this stakeholder who, even if he goes to court and asks for the company to be liquidated, he will still not be paid everything that we owe to him. That is the person we tell him, even if you go to court, you will still lose. So why accept liquidation when you can accept reconstruction and in the hope that we shall make profit in the future? So we are only using step 2 on the assumption that the company is liquidated. I have told you, we are not liquidating the company. Some students come later and say, when we are doing the balance sheet, why are we not paying the debenture holders? We are not paying them. If they could be in the balance sheet, but we are not paying them. We are reconstructing, we are not liquidating. But step 2, we are only assuming, suppose the company is liquidated. Who will be paid, who will not be paid? So that one we were always using it for temporary purpose, not to reconstruct, for temporary purpose, on the assumption that the company is liquidated, on the assumption that the company is liquidated. Otherwise, we are not liquidating. That's a common thing I've found when students are now required, number A, suggest a scheme, number B, prepare capital reduction and the ledger accounts. Somebody unakuta nakuliza, but we paid the creditors, we paid the debenture holders. Listen, we were not paying them. We were only saying, suppose the company is liquidated. Otherwise, we are not liquidating, we are reconstructing. So step 2 was just to help you to determine who among the stakeholders should be requested to suffer the loss in step 1. That's what we were using it for, not for purpose of reconstruction. So when a company is liquidated, I've given you the order of priority. Pay the secured liabilities first. If money remains, pay the liquidation expenses. If money remains, pay the preferential creditors. If money remains, pay the debentures on a floating charge. If money remains, pay the unsecured creditors. If money remains, pay the preference dividends in arrears. And if money remains, pay the preference shareholders their capital. And whatever money remains, now give it to the ordinary shareholders. Whatever the money remains. It could be more than enough or less than enough, but whatever remains. From this illustration, we illustrated and realized that from this illustration, the people who will lose if they go to court are the ordinary shareholders. Why? Because we saw we owe them 6 million in the balance sheet, but we can only pay them 1 million in the case the company is liquidated. So we tell them, don't accept liquidation, accept reconstruction. Please suffer that loss of 5 million with the hope that we shall make a profit in the future. Once they agree, now you go to step 3 and determine the loss reduction per share. And because it's on ordinary, you come and determine the loss reduction on the ordinary shares. On ordinary shares. Take the total loss, divide that by the number of shares. Then I've told you what you got in step 3, which is 8.3 per share, must be part of the scheme. You come and say, 1, ordinary shares to be reduced by 8.3 per share. Then number 2, number 3, number 4, number 5, number 6, number 7 in the scheme, go back to step 1. Good. We have no time to do a question or an illustration. Otherwise, I've given you everything that you need to know concerning this topic now of internal reconstruction. So you can practice on questions that give you a scheme and on those questions that don't give you a scheme first. Otherwise, that is the content of internal reconstruction. Good. So allow me to stop there. Listen, allow me to stop there. If you want to join us for the normal class, we normally have early morning classes. Which starts from 5:30 in the morning, 5:30 a.m. to 7 a.m. every Monday, Wednesday, and Friday. Every Monday, Wednesday, and Friday. If you choose early morning, this is for advanced financial reporting. If you choose evening class, our evening classes are normally from 8 p.m. to 10 p.m. every Monday, Wednesday, and Saturday. Monday, Wednesday, and Saturday from 8 p.m. to 10 p.m. Okay? We are charging 4,000 shillings for the semester. We are charging 4,000 shillings for the semester. That's what we are charging. Now, I am also intending, listen, for people who have done this paper before, that is the advanced financial reporting, and you feel you don't want to join the normal class, we have another stream we are forming next week for special revision. Special revision class. Special revision, we only go through the questions. We take a question from the past paper, we do it. Take a question from the past paper, we do it. Just means I just review the topic slightly and then we do a question. Then we do the questions from the past papers. So some of you maybe feel they have the content of the subject, but they just want revision. So you can join what we call special revision class, which will start next week. I'll give the timetable later. But for now, if you want to join the normal class, those are the timings. That is for advanced financial reporting. Okay? For advanced financial reporting. Some of you, listen, some of you could have friends who are doing financial reporting of the intermediate. I am also teaching it, financial reporting of the intermediate. If you have friends who are doing it and you want them to join, the financial reporting of intermediate is normally from 8 p.m. to 10 p.m. every Tuesday, Thursday, and Friday. Every Tuesday, Thursday, and Friday from 8 p.m. to 10 p.m. if you have friends who want to do financial reporting. Currently, I'm charging 4,000 shillings for any of the subjects. I'm charging 4,000, either advanced financial reporting or financial advanced or financial reporting. If you are interested, you can call me on this number. That is, call me on this number 0722 65 8875. 0722 65 8875. Call me for more details if you want to join. For now, at least let me hear a comment for some of you who are totally new for me. Maybe you are a new person and you want to give a comment. There is a comment Nani gave, Daniel, that he was understanding. Yes. Any other comment, either to improve or to clarify? First, let me ask, was the sound loud and clear? Let me first know, was the sound loud and clear? 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 Yes or no? Was the sound loud and clear? Was the sound loud and clear? You chat and say yes. Okay, fine. Now, another question. Somebody says yes. Another question. Do you feel the volume was too high or too low, or it was okay? The volume of the sound. Is it too high, too low, or it's okay? So you comment there and tell me it's okay, or too low, or too high. Was the volume too high, too low, or okay. You have told me, somebody has said, the sound was loud and clear. Fine. What about the pitch of the volume? Is it okay? Is it too high, or it's okay? Too high, too low, or okay? Somebody says it's okay. Fine. Okay. So let me stop there now. Let me stop there. For those who want to join, please talk to me through this number, 0722 65 8875. You can text or call. Good night. See you next time. I also wanted a comment from somebody who was new. I wanted a comment also. Very clear. Thank you. I also wanted a comment on how the class was. Whether you managed to get something or... So Hillary says the sound was very clear and okay. Sound was very clear and okay. Okay. Fine. So see you next time. See you next time. Okay, listen again. Okay, maybe we can talk next time when you are ready. Okay. Bye.